Number one, you blame trade policy a lot more than the Fed for this. And my point to you was, if you knew that we were going to have a slowdown and you knew that the trade policies were going to be a headwind, then why weren't you urging the Fed not to move? Or do you admit maybe it was a mistake that they moved as quickly?
So what we have said, so when we originally had the call for the slowdown, we thought it was going to be a little bit sharper, a little bit sooner, and that the Fed would see the data in time and actually skip the December hike. We obviously had to capitulate on that once we got a series.
You thought they might skip?
We thought there was a good chance of that way back in July, and we got so much hate mail for saying that. People thought we were completely crazy, and then by the time we got to November, people started thinking, wow, maybe you guys aren't so far out. And then even leading up to the December hike, even though the data coming in were still clearly strong enough for them to hike, we said, we think the Fed will hike. Boy, we don't necessarily think that they should. So that's a big change in what my job is now, is I'm supposed to be telling people what I think they will do as opposed to what I think they should do.
You're not ready to throw Powell necessarily under the bus in terms of his communication skills, but you think it needs some refinement, but it's not, they weren't disastrous comments or rookie mistakes, or how would you characterize them? Just not quite?
Right. So I don't think they have shrouded themselves in glory with their communication. I think at the Fed there tends to be a premium on precision of language as opposed to clarity of communication. I think what Jay is trying to say to markets, to the world, is if the economy is strong enough, we will keep hiking. But if there's weakness, we're not going to put our heads in the sand. And I think people are missing that. They're only hearing the first part, which is we see strength in the economy, and as a result, if it stays strong, we'll keep hiking. But I don't think they're so clueless as to hike into a soft bet.
The nuance about China and talking to you think that the trade war is a bigger issue maybe than the Fed. You think that's why the market is having some problems. A lot of people that say that even are willing to accept it, given that they think maybe now is the time to start addressing some of our long-term concerns with the way China does business. So they think, okay, we don't like this, it's going to hurt, but we'll accept it. You know, we've got to do it at some point. So China's weak today, the PMI, and we're going to go down. Is it because our domestic economy is already feeling the weakness from a supply chain problem with China, or is it because China is weak and it's such a linchpin of global growth that it just puts us in a negative frame of mind in terms of global growth and oil demand and everything else? Is it really our problem yet? Is it contagion from there, or is it China is just one of the leaders in incremental GDP growth globally? I don't know how much.
Second to China.
Yeah, it's important. So it's the old adage: no one wins in a trade war. You hurt the guy, yeah, he's hurting, but
sure.
Cutting
off one's.
Right.
I mean, that's the best part about being a macroeconomist is you don't have to pick just one explanation. All of these factors affect each other. You were talking earlier about oil prices. And whether or not it's a tax cut for people, and if it's good. We'll go even further and say not only is it not a good thing if oil falls further from here, it's a serious risk to the U.S. economy. So if WTI gets below $40 a barrel, what you could see is a replay of what we saw in 2015 when oil production, fracking, and all the investment and hiring that goes along with it in West Texas just shut down completely. And we saw 2015 could have been a much stronger economic growth year than it was, but because oil fell so much of that investment spending and so much of that hiring fell off of a cliff.
So it's not just marginal anymore.
Not at all, absolutely. In fact, I think that's the biggest risk that people make still, is that they think lower oil prices are good for the U.S., but we're getting close to being sort of neutral in terms of imports, and the amount of capital intensivity and hiring that goes on with fracking. It's just a massive support for the U.S. economy. So low oil prices are a big risk.
You characterized potentially a soft patch for this year. You said the Fed wouldn't be so clueless as to hike into it. Is that all it's going to be? And I guess what gets us out of this psychology of globe is weakening, our companies, obviously have to soften up their earnings outlook and all the rest of it?
Yeah, so our baseline forecast is that it is a soft patch, and then after a while, firms learn how to go around the tariffs. We've seen that in the past. No one likes to pay taxes with tariffs. You find a way around it. If things hold up, if oil doesn't fall off of a cliff, then yeah, we think it's just a soft patch. And by the time you get to Q2 and into Q3, things start to perk up just a bit more to get back to where you would have been without the trade war. But I'm not going to bet the farm on that, because as we've seen, oil is falling even more than we had anticipated, and there are clearly risks all the way around.